Northern Genesis Acquisition, or NGA, is a SPAC which is going to be taking Lion Electric public in the first quarter. The problem is that the price has already rallied over 200% and represents a poor entry point. So what can we do to get on board this high-flying SPAC instead of chasing it? Hi, I'm Doc Severson for the Ready, Set, Trade of the Day for Wednesday, the 20th of January. Here is the daily price chart of NGA. Again, this is the SPAC, which eventually will merge with Lion Electric and become its own ticker. But for now, this is the vehicle that we can trade with. And you can see from the standard price floor of a SPAC of about $10 a share, this thing is put on over 200% to the upside. This represents a very poor way to just ape in to the price and just hope it continues going higher from there. So what we can do is we can either look for a pullback, or there's other ways that we can get on board this and still win a trade. First of all, we'll look at the price chart and figure out where the value spots are from this trade. The first thing that we can do is add fib retracements to the chart and come up with what we consider to be good landing spots for the price. So what I'm going to do is take the most recent major swing of the stock on NGA and draw it from bottom to top. From here, we're going to focus on three major retracements: 38.2%, 50%, and 61.8%. The next thing I'm going to do here is add price pivot levels. What I'm going to do is look for former resistance, which becomes new support. And so we see one of these levels here at $20 a share. We see the next one of these at $24 a share. So former resistance becomes new support. So that's 20 and 24. And then from there, it's been a straight ride higher. So I like to use a technique called confluence. What we're looking for is more than one signal at a time. When we marry these pivot points, former resistance becoming new support, and these price floor levels with fib retracements, probably the best entry at this point is to sit there at 24. Now, what if the price never comes down to 24 and fills me and allows that advantageous entry? Well, this is where we can use a strategy with options called cash secured puts. So let's carry over these two price levels that we're interested in, 20 and 24, over to the option chain and see what we can do with them. Now, here's where it gets confusing for people, because all of a sudden they go from one single price chart where it's just running in two dimensions by price and time, and all of a sudden we add an infinite amount of complexity. It's really not that hard if you know what you're doing. So first of all, we're going to look at the 19 February options, and we can see that there's not much meat on the bone. There's not much extrinsic value left for these options. We could trade them, but I think it might be a better deal to give ourselves a little bit more time to let this play out and go down to the March options, which have a little bit more time than I'd really like at 58 days. But I think this is a better choice versus the 30-day options. So we'll just focus on the March options for right now. And if we look at this, we have a couple of different strike prices that we can play. Remember that 20? And now we don't have a $24 strike. We do have a $25 strike, which is paying a lot, but it is above our level of support that we have identified. So to me, the best trade here is at $20 a share and selling the $20 puts. In practice, we could probably fill these for about $1.25 to $1.30 instead of the natural credit of $1.20. But let's just carry this forward using $1.20 for this example. If I sell that $20 put all the way out in March, so the March $20 put, what I'm doing is I'm obligating to buy NGA at March expiration in 58 days if the price is at or below $20 a share. If that didn't make sense, go back and rewind that and listen to it again. As long as the price stays above $20 a share, I don't have to do anything. So let's look at the numbers. If I pull in $120 of credit per contract, the cash that I need to buy 100 shares is going to be $2,000. And what that means is that sitting on my hands for the next 58 days means that I'm going to pull in a 6% return on my capital. Leverage that across the course of a year, and you can see that this can be an extremely effective strategy with some of your capital. That's not 6% per year. That's 6% for the next 58 days. So from here, if the price goes higher after I fill that put for $120, remember that goes straight into my account on day one. $120 shows up into my account. That's cash that I can use for whatever. If the price goes higher from here into March expiration, I do nothing. The puts expire and my obligation is released on expiration day. If the price goes sideways, same deal. Obligation expires in March expiration. Even if the price goes down somewhat, down to that $24 a share that we talked about, I still do nothing. I'll let those options expire. It's only if the price goes all the way down to 20 or lower by March expiration that I'm on the hook to buy those shares, which is what I wanted to do in the first place. I wanted to buy NGA, and now I'm getting paid to buy it at a severe discount. What could be better? This is one half of what's called the wheel strategy, which we explain in a free course if you sign up for the 10X Tribe, which is for free at elite.readyset.trade. Thanks for listening. We'll see you in the next one.